Hello friends, here we'll be discussing the bank financial management, exchange rates and the forex businesses. So friends, see what is the structure of this chapter. Objectives, introduction, foreign exchange definition and the market, factor determining the exchange rates, exchange rate mechanism, foreign exchange dealing room operations, then derivative product, RBI and FEDI guidelines, foreign exchange arithmetic concept and the examples. After that, we are having some objective of this unit. So after that, you will understand the definition and the type of the exchange rates, the mechanism and the markets, the factor affecting the rates, the related guidelines, how a dealing room operates, forex operation in India and various guidelines. So friends, let's start the syllabus. See some introduction part. So see here, the word trade, export and import of a commodity, cross-border movement of the manpower and the capital, travel and tourism and export of a software and the services, all necessitates the need of the exchange of a currency of a one country into the currency of a other country. So friends, what do you mean by it? See here, the trade, then export and import, then cross-border movement of the manpower and the capital. So see, export, what do you mean by export? See, from India some things are being exported to USA. So in that return we have given, suppose Tata cars, right? We have given some cars manufactured by the Tata to the USA. So in that return they will send us the dollar in India, right? So these are the part of export. Now import means, suppose we have imported the Microsoft softwares from the Microsoft from USA to India. Okay, so we have to give them some money, right? So what we will do, so we cannot offer them the rupees. They will say, oh, rupees are not valid in our country, please send the dollars. Okay, so in the same case, if we import something from the USA, right, then what we say, we will say give us the Indian rupee, we don't accept the dollar. So in that case there need a currency exchange, right? So see here, next, import of the commodity, right? Then cross border movement of the manpower and the capital. Suppose some Indian people, they work in the USA, right? So they will earn their dollar, but they have to send their money for their parents in the India. Whether dollar will be allowed in India? No, in India we operate only the Indian currency rupee. Okay, so dollar need to convert to Indian rupees. Apart from that, some travel and tourism. So if you are going to the Washington DC or the New York in the USA, right? So you have to carry their currency. If you went there, by the way, by taking the rupee, then it is not allowed. They will not accept the Indian rupees, right? So obviously you have to convert whatever the rupee you are having to the dollar, then only you can operate in the USA, right? So export of the software and the services all necessitates the need of the exchange for the currency of one country to other currency of the other country. Okay, so these are the reason, that's why we need what, the exchange of a currency of one country to exchange of currency of the other country. That means currency conversion from rupees to dollar, currency conversion from rupees to dollar and dollar to rupees or Japanese yen, like that. Okay, that means currency of one country has to be converted to currency of other country. Why? Because we are doing the business like a trades, import export, then cross border movement of the manpower, capital movement, okay, then travel and tourism. So these are the reason, that's why we need to change one currency to other currency. Okay, now see, the export of the goods manufactured in India or export of the software to the USA are paid in the dollars, right? When the exporter need to convert the USD proceeds of the bill into the Indian rupee. So in case of export, what is happening? So whatever we manufacture, say example of Tata cars, okay, we have manufactured the cars in India by the Tata, and that we are exporting to the USA. What happened? So if you export, right, so what we have to do, we have to, whatever the bill the Tata is giving to the USA party, obviously it should be in the dollar, because they only understand the dollar, right? So the exporter Tata need to convert whatever the bill, suppose 2000 dollars. Okay, this is suppose the bill that 2000, suppose the bill is suppose 2000 Indian rupees, that need to be converted in the form of a dollar. It may be whatever is the rate, right? Depending on, it has to be converted into the dollar, and that has to be given to the USA party. Okay, because the USA party doesn't understand the bill in the rupees, right? They want the bill in the dollar. Okay, so that's why in case of the export we need the foreign exchange. Apart from that, in case of the import of the capital, similarly, import of the capital goods from Germany to India, invoice should be in the euro, and it has to be paid in the euro by converting the Indian rupee into euro. What do you mean by it? Simply, suppose in India we have imported from the Germany. Okay, suppose this is the Germany, and from that Germany we have imported, suppose the Volkswagen cars we have imported from the Germany to India. Okay, so whether they will send us the bill in the rupee or the in the German currency, say euro, they will send, suppose they have sent the bill in the euro, for example 1000 euro they are demanding, but the Indian importer don't know how to pay in the euro. So that Indian importer will go to the SBI, and they will say, oh, I have to pay 1000 euro to my German party, please convert 1000 euro to the 1000 whatever the currency you have to convert into the euro. Okay, so that is nothing but whatever we are doing the export of the good, we are doing the import of the good. For that reason we need to convert one currency into the other currency. Okay, so for understand here, for export of the goods means what, here is the India and here is the USA. So we have exported some goods to them. Okay, so in that return we will get what, dollar. Simply, right? Simply understand. So what this is, what this is the inflow of the foreign currency. Understand it? So when there is an inflow of the foreign currency means what, when you are getting something, and here the case is what, the foreign currency. This is what, this is the buying case for the foreign currency. Okay, now see here, in case of the import, what you are doing, here is India and here is USA. Okay, so what you are doing, importing. So India is what, importing some goods from the USA. In that return we have to give what, we have to give them dollar. So here is what is happening. So remember, in case of import, what is happening, the foreign currency is going away. When something go away, when something go away from you, when you sell it, so this is the selling case in the foreign currency. Okay, so all that part we will be discussing in the later when we solve the numerical. Okay, so here what we are going to learn here, in case of the export also we need to convert the one currency to other currency. In case of the import also we have to convert one currency into other. And also we learn here, what do you mean by export? Export means we are exporting something, so we receive the foreign currency, that's why it is the buying case. In case of the import, we receive the foreign goods and we pay the foreign currency, that's why it is the selling case. Okay, so that two things you have to remember. Now see, thus the conversion of currency from currency of invoice to the home currency of the exporter will be generally required for all cross-border trades. This is the foreign exchange. Foreign exchange is more broadly used to denote the foreign currency. So simply, what is foreign exchange? You learn here, what is the foreign exchange? Foreign exchange means converting one currency into the other currency. That means converting what? Simply, in case of export, what do we convert? In case of export, we have exported something, right? So we have exported, so we will receive the foreign currency, and that foreign currency need to convert to the home currency, say rupee. So this is what, this all transactions are nothing but the foreign exchange. So in simple word, what is a foreign exchange? Converting one currency to other. This is nothing but the forex. This is nothing but the forex. Forex means foreign exchange. What is foreign? Foreign stands for the foreign currency, and we are exchanging here the foreign currency with the Indian rupee. That means we are doing the forex transaction. Very simple. This is all about the introduction. Now see, according to the FEMA, FEMA means the Foreign Exchange Management Act. Remember, FEMA stands for Foreign Exchange Management Act. So according to the FEMA 1999, section 2, it defined the foreign exchange. So how the foreign exchange can be defined? So in broadly we say foreign exchange means conversion of one currency to other. But according to the Act FEMA, the foreign exchange is defined as how? The foreign exchange means the foreign currency. Foreign exchange means simply the foreign currency, and it should include what? Simply see, all the deposits, credits and balance payable in the foreign currency. Any draft or the traveler checks or even letter of credit or the bill of exchange expressed or even drawn in the Indian currency but payable in the what? Foreign currency. So very simple. Foreign exchange means the foreign currency, right? And it should be payable in the foreign currency. It should be payable in the foreign currency, whether it is your deposit, credit or the balance, whether it is your traveler checks, whether it is your letter of credit, bill of exchange, whatever is the instrument, it should be payable in the foreign currency, and that's why we call it as a foreign exchange. Now see further, any instrument payable at the option of the drawee. Here option of the drawee means what? The bank. Holder means the person holding it thereof or any other party thereto, either in the Indian currency or in the foreign currency, or partially in the one and partially in the other. So whatever it may be, that are partially convertible in the foreign currency, okay, that should be treated as the foreign exchange. So broadly, how can we say? Broadly we can say the foreign exchange is all the claims payable abroad. Okay, so see, for example, if you have to pay rupees in the USA, if you have to pay dollar in the USA, so all the claims which you pay abroad, whether it is a home currency, whether it is a foreign currency, but you have to pay in abroad, that are nothing but the foreign exchange. Okay, so simply what is a foreign exchange? So you don't need to worry about the terms, like for example, what? Like a traveler's check. What is a traveler's check? So previously it was very much famous. For example, if you have to go to the USA, so your checkbook of SBI will not be allowed there, so you have to take the traveler's check from SBI so that that check can be valid in the USA. Okay, that is called as traveler's check. What is a letter of credit? We have discussed the detailed letter of credit in the same chapter ahead. What is a bill of exchange? That also we will be discussing. So don't worry about the term letter of credit, bill of exchange, like that. Okay, so you just concept, you should get clear here the concept. So what is the FEMA says? According to the FEMA 1999 section 2, it defines the foreign exchange. How? Whatever the instrument we are having, that should be payable in the foreign currency. First, or second, what? It should be payable abroad. Only 2 points you understand. First, it should be payable in the foreign currency, and it should be payable in the abroad. It should be payable abroad. What do you mean by that? See, it should be payable abroad. Okay, means whether you pay in the rupee, whether you pay in dollar, it should be payable abroad is the first criteria, and second, it should be payable in the foreign currency, means you should only pay in the dollar. Okay, so that two criteria are there. If that two criteria are satisfied, then we can say this is the definition of the foreign exchange as per the FEMA Act. Okay, very simple. Now let's discuss here. In other words, we can say the foreign exchange transaction. In other words, we can say the foreign exchange transaction is a contract to exchange funds in the one currency for funds in the other currency at the agreed rate and agreed arrangement basis. What do you mean by that? See, 1 USD is equal to say 80 Indian rupees. What do you mean by that? See, whatever you are exchanging for $1 to 80 rupees, it is what? It is a contract to exchange the fund in one currency. That means one currency means say dollar, for funds in other currency say rupees, at agreed rate. What is the rate? So I will exchange, suppose a $50. I want $50 for Indian rupees. Okay, so what is the rate? $1 for 80 rupee. So you want $50, so you will take 80 into 50. Okay, what is agreed rate? $1 for 80 rupee. What is arrangement? So arrangement means what? I want this rate after 2 days. I will purchase this after 3 months, whatever is the arrangement. Okay, so there are different arrangements are there. There are OTC arrangement, there are forward contracts, okay, there are future contracts, there are options, swaps, there are different arrangements. Okay, that we'll be discussing in later. So here you just understand what is the foreign exchange transaction. Means it is simply the contract to exchange the fund from one currency to other currency at agreed rate, and at agreed mechanism. Okay, so simply exchange rates thus denote the price or the ratio or the value at which one currency is exchanged for other currency. Simply $1 is equal to say 80 rupee. It is what? It is the ratio of dollar to rupees. Okay, or it is the value at which one currency is exchanged for the other currency. Simple, right? Now see further, the number of units of one currency which are exchanged for a given number of units of other currency is called as the exchange rate of the currency. For simply $1 again is equal to 80 Indian rupees. That means $1 is exchanged for given number of units of other currency, means 80 units of the other currency. This is what the exchange rate of the currency. Now for example, again $1 is equal to 82.4 what Indian rupee, or we can say 1 euro is equal to 1.05 of dollar. Okay, so this is all about what? This is all about the exchange rate. Okay, now further see, exchange rate is a dynamic rate. Why? What is mean by dynamic? See, there are two types, static and the dynamic. Static means which not change. For example, see, for example, static means, see, India. Okay, what is the length of India? Suppose it is a 3000 kilometer. Okay, so this is static, will not change. What is dynamic? What is time now? Time now to is a 5 a.m. What is time after 2 hours? It is the 7 a.m. Okay, that means this is dynamic. Okay, very simple. So static means constant and dynamic means which is continuously changing. Okay, so the similar way exchange rate is dynamic. That means it is changing. It vary from day to day, it vary from minute to minute, and even it vary from second to second. So depending on the variety of the factor. So what is the exchange rate? So $1 is equal to 80 rupees. So it will change. If you check it now, after 5 seconds it will be changing like 80.4 rupee. Okay, so what I have to say? I have to say that whatever the exchange rate, these are very much dynamic in nature. What do you mean by it? It means it is changing day to day, minute to minute, or even second to second. It changes. And why it changes? Then it changes depending on the different number of factors. So that factor we will be discussing now. Okay, so see, if we view the market as in terms of the GMT, what do you mean by GMT then? GMT stands for it. So you know the time zones are there. So GMT is what? The Greenwich Mean Time. There are different time zones. Greenwich Mean Time. So what is Greenwich? Greenwich, it is the location in the London. Okay, it is location in the London simply. Okay, so they have their time. They call it GMT. So in India we follow the IST, Indian Standard Time we follow. In London they follow the GMT. So there are different time zones worldwide. Okay, so when London and other European markets, so you can see here, so we are having the Forex market in India. Okay, so what time we will follow? We will follow our time, Indian Standard Time. In case of London or the UK, they will follow their time zone. They have their GMT, Greenwich Mean Time. Okay, so you know, right? So the earth is round. Okay, and earth rotate around the sun. That's why there are different time zones. So what is time here will be different. What is time here on the earth, and what is time here on the earth. Okay, so these are very basic. Now see, when Indian market, see here, when London and other European market start their day almost lunch time for the Indian market. What do you mean by that? So when they open their market, when in London they open their market, almost in India we are having lunch time. Means what? India is ahead 5.5 hours than the London. That's why. So in London when they open their market, it is almost lunch time in the India. Why? Because simply India is ahead of a 5.5 hours to the London. Okay, now see, when Indian markets about to close, when Indian forex markets about to close, the New York market is about to begin. That means they are around almost 10.5 hours behind us. That means the India is ahead 10.5 hours to the USA. That's why we can say when Indian market about to close, the USA market about to begin. Further, while the New York market operate sometime alongside the London and the European market, and a market in the east, say Tokyo, Hong Kong. So what do you mean by that? See, there is some time difference between what? Between the New York, London, and Tokyo, Hong Kong also. But what? Sometime alongside they will operate. So there is some time when they will their time of operation will coincide. Okay, for example, New York, this is time of operation. London, this is time of operation. And New York or the Hong Kong, this is time of their operation. Okay, so this is the time when all they can coincide. Okay, so simply what I have to say, New York or even London or even say Tokyo or Hong Kong, their working time of the market can collapse. Apart from that, the important thing, Singapore are ready to start before the New York closes. What do you mean by that? Simply, Singapore is 13 hours ahead of the New York. So when Singapore is starting before the New York closes, means what? Singapore is 13 hours ahead of the New York. That's why we can say, see, these are not important for exam point of view, but you should understand why. See, this forex market is 24/7, it is working. Why? Because there are different time zones in the world. Okay, so this is given in your book, that's why I have taken here. Okay, now further, see, the world currency market is a very large market, right, with the large number of the participant in it. Okay, so we talk about the forex market. So then who are participating in that market? So we will discuss some major participants in the forex market. So let's discuss one by one. First is the central bank. What is central bank? Here central bank refer to, say, for India, RBI. So RBI manages the forex reserve. See, whatever the foreign currency we are having now, that is held with the RBI, because RBI kept this forex reserve. Okay, so RBI manages the forex reserve using the foreign currency market to reduce the volatility, smoothen out the value of the home currency. So RBI is having, say, suppose a 5 billion US dollar. Okay, so that 5 billion US dollar RBI is having as the forex reserve, and RBI will take some decision about that forex reserve. What? And that decision should be to stabilize the value of the Indian currency rupee. Okay, to smoothen out the value of the home currency. Okay, so for that RBI works. Next is the commercial bank. So what are the commercial banks? Say ICICI Bank, HDFC Bank, SBI, Bank of Baroda. These are offering an exchange of the currency to their big and retail clients. So obviously we offer, different customers are there. They come for exchanging the currency, we offer them. Hedging and the investment. What is hedging? That we'll be discussing later. Okay, so hedging means basically to avoid the future risk, there is some investment is being done. That is basically the concept of hedging. Okay, so hedging and investment in their own asset or liability, or even for on behalf of the client. Okay, so whatever the clients are coming, whatever the customer coming to, say, SBI. Okay, so SBI will invest their fund into their own asset, say SBI life insurance. They will offer there some product. Okay, otherwise they can act as agent for the investment in different companies, say Motilal Oswal. Okay, so there are different commercial bank who offer the exchange rate of currency for their clients. Okay, either they can use their fund for investing in their own asset liability. Okay, otherwise we can say on behalf of their client they can invest in other companies also. That means SBI can invest in other company. Also, the speculating and taking view on the exchange rate movement in the market. So commercial banks, say SBI, ICICI, they can guide their customer what will be the possible movement in the market, so you can invest in which currency. Okay, so that can be done by the commercial bank. Now next participant in the forex market is the investment fund or the bank. So what are the investment fund? See, you will get like a Kotak Securities, then Motilal Oswal, okay, then ICICI Securities. So these are what? These are the investment fund. Okay, so moving fund from one country to another using the exchange market as a vehicle for the investment, and also hedging their investment in the various country or the currency. So these are the investment fund, right? They are helping their clients for the purpose of investment. Also there are some banks which are also working and helping their client for the purpose of investment. Okay, so simply investment fund and the bank, these are the participant in the forex market. So simply I will say here, you can see there are different currency exchange funds are operating in the India. For example, here you will say the Motilal Oswal fund. Okay, so Motilal Oswal was, this company will enable you to transfer the Indian rupee to the USA in the form of a dollar. So what, for it may be for the purpose of investment in the USA or for any other purpose. So same can be done by the banks also. Okay, now next is what? The forex broker. Brokerage means what? Simply these are acting as the middleman between the other participants. Okay, apart from that, there are some corporations, or you can say corporations or the corporates. These are moving front between the different country, okay, or different currency for the purpose of the investment or the trade, that is import export, or even for the speculation, okay, in the foreign currency markets. Okay, so these are the basics in the basics and participant in the forex market. Okay, so apart from that, the most important is you and me. Like you and me means what? The individual. So ordinary and high net worth individual also using the forex markets for the purpose of what? For the purpose of the investment, trade, personal, or the travel and tourism. Okay, so very simple. So who are the major participant? Major here, major refer to the broadly. Here major means here broadly. So broadly there are different participants in the forex market. Central bank RBI, commercial banks say SBI, ICICI, then investment fund like a Motilal Oswal, ICICI Security, other banks say Canara Banks or Baroda Bank, like that. Apart from that, there are some forex brokers are there, some corporations are there or corporates are there, and very important, you and me like individual, we can go to travel abroad for tourism purposes, right? So we need foreign currency. So these all are what? These are participating in the forex transactions. Okay, very simple. Now what we have to learn, see here some important statistics we have to remember. Okay, for exam point of view, there may be a question, so let's discuss it. See, it may be the surprising to note that the global forex market having daily turnover hit approx what? USD 6.6 trillion in 2020. So here you remember, what you remember, what is the daily turnover of the forex market? It is about 6.6 trillion in 2020. Okay, so there will be direct question in your exam, that what is the approximate daily turnover of the forex market, global forex market. So what is it? It is the 6.6 trillion dollar, 6.6 trillion dollar, and that amount is what in 2020. So which is the 40% increase in daily forex volume over the last decade. So that means how tremendously the foreign exchange has been increased. Okay, so you remember only the figure, it is what? 6.6 trillion USD. It is what? It is the daily turnover in the forex. Now see some comparison between 16 to 19, that means 2016 to 2019, daily forex volume jumped 30% and it is grown up by 1.1 USD trillion over the period. Okay, so see in that 3 year 16 to 19, what the forex volume has been increased by 30%, and it is it is grown up by 1.5 USD trillion. Okay, during that 3 years period. Primarily why? Due to the surge in the forex swap, due to the increase in the swap. What is swap? That we will be discussing later. Okay, it is one of the derivative, it is instrument used in the foreign transaction. Okay, so due to the increase in the forex swap for liquidity management or the hedging of the foreign currency portfolio. Okay, so here Why in that 3 year there is a 30% increase, and it is almost 1.5 trillion USD? Due to what? Due to the swap and the hedging. Due to what? Swap and the hedging. Apart from that, in 2019, forex swap has compromised around 49% of the total forex market turnover. So see how the forex swaps are important. Almost 50%. 49 means almost 50%. It is contribution in the forex, right? And the spot transaction also grown up by the 30%. What is spot? That we'll be discussing in the upcoming session. Spot transaction. Spot means next working day. Okay. So in the Indian forex market too, the average daily turnover or OTC means over the counter, has increased from 5 billion USD in 2004 to 34 billion USD in 1920. Okay, there is huge increase, and the exchange traded derivative have also shown the exponential growth with the daily average turnover about USD 12.2 billion dollar. Okay, so in India, for this point you should remember, in India what we are having the daily turnover. In India we are having the daily turnover of 12.2 billion dollar. 12.2 billion dollar. In case of a globally, what is the turnover? We are having in globally, we are having 6.6 trillion dollar turnover. For India we are having 12.2 billion dollar turnover. Okay, that two key point you have to remember. Now you understand here the term. What is the OTC? OTC stands for over the counter. What do you mean by that? See, if you have to take some medicine, you will go to the medical store, right? So if you have to take the simple medicine, say paracetamol tablet, okay, you can go to the counter of that medical store, and you can ask, give me one paracetamol. He will easily give you that paracetamol tablet or any Vicks tablet. Okay, so you give money, he will give you the tablets. Okay, so you don't need any rule, you don't need any prescription, so over the counter you got it. Okay, so if you are going there, and if you are asking for multiple tablets, like a sleeping tablets or any headache tablets, multiple tablets you are asking, so whatever the owner of that medical store, he will ask you, give me the prescription of the doctor. Okay, I will not give without prescription. So what do you mean by that? First you got here the tablets without prescription, so these are the over the counter. But here the medical representative demanding you the prescription, that means these are not over the counter. So understand, in the same concept is here for us in the forex. So whatever that transaction occur without any specific and hard rule, these are the over the counter transaction in the forex. Okay, and the transactions which are having having middleman is involved. So here like a prescription is involved. In the same way here the stock exchanges are involved, like BSE, NSE. Okay, so these are different stock exchanges. So in the similar way there are third parties involved. Okay, so these are not over the counter. Got it? So the same concept is here. Okay, you can easily remember it. Okay, the forex markets are highly dynamic. On average, the exchange rates of the major currency, say GBP to USD, fluctuates every 3 to 4 seconds. So you can see here how much it is fluctuating. See the rate. So every 3 to 4 seconds, there is change in the exchange rate. So we can say, which effectively mean it about 21,600 changes in a day. So whatever the change, say rupees to dollar, how many times it changes? Around say 21,600 times it changes in one day. How? 24 hours, 60 minutes, and in 1 minute 15 times. In see 4 times in a second, so that means in 1 minute 15 times. So when you multiply this, you will get 21,600 times that rate changes. So how that market is dynamic. Okay, now see here further, forex markets are usually operates globally. That means Monday to Friday. So what is working day? Monday to Friday. The bulk of forex markets are OTC. OTC means over the counter. Okay, meaning that the trades are concluded through the telephone or the other electronic systems. Okay, that is OTC. I have already explained you the OTC. Now see here, So there are some characteristics of the foreign exchange market, that is a forex. Okay, what are that characteristics we will see here. So see, so friends, see the characteristics of the forex market. First, it is a 24-hour market. Next, an over-the-counter market as well as the exchange-driven market. I already told you the difference between OTC and not OTC. And not having the OTC means what? Obviously, some intermediary is there, like exchange markets, like exchanges. So it may be the OTC, or it may be the exchange-driven market. That means middleman is involved, like different exchanges. Okay. Next, the global market. It is a global market with no barrier and no specific location. Right? It is global market. What is the forex market? It is a 24-hour market. It may be the OTC. It may be the exchange-driven market. It is the global market. It is the market that support large capital and trade flow. It is a highly liquid market. See, every 4 seconds the value changes. That means it is a highly liquid market. Okay. The high fluctuation in currency rate every few seconds, that means almost every 4 seconds the currency rates changes. The settlement affected by time zone. There are different time zone, right? We have already discussed GMT, IST. There are different time zone. So obviously the settlement means what? If you purchase dollar in India and that has to be settled in the USA, so how it will settle? Because there is a time difference. Okay, they are lagging us by 5.5 hours, almost 5.5 hours the USA is lagging. So we can say settlement should be affected. It is affected by the time zone factor. So market affected by the government policy and the control. Obviously there are some control, like RBI gives some guideline, the Indian government issues some guideline about other currency. So obviously it is affected by the government policy and the controls. Okay, so let's check some terminal questions. See here, the term foreign exchange is used to denote dash dash as well as the dash dash of the one currency into another. So what is the answer? See, the term foreign exchange is used to denote what? To denote the foreign currency, to denote the foreign currency, as well as the dash dash of one currency into another. That means that is what? That is the exchange of one currency into the another. Next, the exchange rate of a major currency fluctuate every how many seconds? Okay, for every 4 seconds. For every 4 seconds the exchange rate fluctuates. Now, true or false? The forex markets are dynamic and round the clock market. Yes, it is dynamic and round the clock market. 24 hours it operates. So it is a true statement. Forex markets are not affected by government policy. It is a false statement. It is affected by the government policy. A large part of the global forex turnover result from the global commodity trade. So whether it is from commodity like gold or cement, it is not from the global commodity, it is from the swaps, hedging. Okay, so it is also again the false statement. Okay, so in this way we have discussed the first part. So the important thing we'll discuss now, the factor which affect the exchange rates, foreign exchange. So you have to purchase dollar by giving the rupee. So how much you have to pay? So how that rupee and the value of a dollar is being determined? So $1 is equal to 80 rupees. How it is being fixed? So there are some factors which affect the foreign exchange rate. Okay, so there are some fundamental factors, there are some technical factors, and there are some speculations. Okay, so remember there are 3 basic factors or 3 basic reasons: fundamental factors, some technical, and some speculation. So fundamentals are important because see, fundamental are the reasons or the factor which affect that rate for long term. Okay, so see here, these fundamental includes cause or the events which affect the basic economic and the monetary policy of a concerned government. These cause normally affect the long term exchange rate. So what will be the value of a dollar for the Indian rupee? And whatever the reason or the fundamental, if the fundamental reason is what, say government policy, so that will affect for longer duration. The policy will be for longer duration, right? It is not for temporary. Okay, so temporary fluctuations are not part of the fundamental reason. Whatever the long term price of a foreign currency with the home currency that are being determined by the fundamental reason. So I repeat, you have to remember fundamental reasons are responsible for the long-term price change in the currency. Okay, so now discuss one by one. See, in long run, exchange rates of the currency are linked to the fundamentals. Okay, long term. Okay, now let's discuss the fundamental factors one by one. First is what? The balance of the payment. What do you mean by it? See, generally surplus in the balance of payment lead to the stronger home currency, whereas deficit will weaken the home currency, obviously. Okay, so let's understand here what do you mean by balance of payment. See, there are two types basically, balance of a trade and balance of the payment. What do you mean by balance of trade? See, if you have exported something, if you have imported something, okay, so trade means what? Export import, balance of a trade. So if you have suppose exported 100 rupees for 100 rupees and you have imported suppose 70 rupees, so what is the net here? Net will be 30. Okay, it is positive balance of a trade. So this is what 30 rupees as a balance we are having from the trade. Now what is the balance of payment? Suppose Indian people have invested abroad, say 500. Okay, and in India we receive the investment by the way of a foreign institutional investment. Then the NRI are sending the fund to India, NRI. Then the NRI people, foreign institutional investors, so these are investing in India. Suppose they have invested 600. Okay, so whatever the balance of payment means, whatever, say again the FDI investment you can add 100. Okay, so total 700 we received in India, right? And we have invested the 500 abroad. Okay, so what is the net? Net is 200. What? It is the balance of the payment. So you understand here, balance of a trade refer to the import export, that is trading activity. And balance of payment here what do you mean by that? Here exchange of the goods happen. Okay, here exchange of the goods happen. And in case of balance of payment, here is no exchange of the goods. No exchange of the goods, because directly investment, simply balance of payment is a part of the investment. It is a part of investment. It is a part of the trade. Okay, so here no exchange of the goods. So simply, ultimately, see here plus 30. Ultimately, what you have to do at the end of the year, you have to transfer that 30 rupees to this section, balance of payment. Okay, so understand what is the balance of payment. You are here remaining 200 as the balance of payment. That means you receive more foreign currency than whatever you have you went from your country. Okay, so whatever the more the balance of payment, that means it is good for your currency, right? And that's why this is the basic difference between balance of trade and balance of payment. Now we can see here, see, if you are having more balance of payment, that means positive surplus balance of payment, that means you will have stronger home currency. So your rupee will be stronger, and you are having deficit, that means your currency will be weakened. Okay, now next is what? Economic growth rate. See, a high growth lead to a rise in production, and export also increases, and a rise in the value of a home currency, and vice versa. Obviously, see, if your economy is growing, your production is good, then your export will be good. And if everything is good, everything is increasing, then whatever your currency will be stronger against the foreign currency. If your economic growth is less, production is less, export is less, then your currency value will go down. Very simple, right? Next, fiscal policy. What is fiscal policy? See, fiscal policy means the policy, say simply budget. It is the budget. Who gives the budget? The finance ministry. So the fiscal policy is given by the finance ministry. So we are having two types: expansionary fiscal policy and the contractionary fiscal policy. So what do you mean by expansionary? Expansionary means you spend more. So government will spend more. Government will decrease the taxes. So government spending more, government decreasing taxes. So this can be good for the corporates. So they will say, oh, less taxes as in India, government is spending more, so there will be boost to the economy. So whatever the different corporate, due to the less taxes, they will produce more, they will export more, so it is good, right? So in this way, the fiscal policy affect the, or these are the factor for the long term, that is fundamental factors. Okay, now what is the, in case of a contractionary? In case of a contractionary, what government will do? Government will spend less, government will increase the tax, so there will be less production, and less production means there will be what? There will be less the home currency, that is a rupee will be weakened. Okay, so less export, so weakening the home currency. Okay, so in this way, fiscal policy is one of the important fundamental factor for the which drives the exchange rates. Then monetary policy. What is monetary policy? Simply the RBI. Monetary is RBI. The way central bank, say RBI, attempt to influence the control of the interest rate, money supply in the market can impact the value of a currency. So simply see, if RBI lower the what repo, repo rate, the rate at which we take a loan from RBI, we take money from RBI. RBI lower the repo rate, we get the money from RBI at a cheaper rate, and that's why we can give money to the customer, give loan to a customer at a cheaper rate, so more customer can take loan. Okay, that means there is a expansion, there is inflow of money in the market, so that's why it is good. So more market money, more people will set a factory, more export will increase, and it is good for our country that our export will increase and our stability to home currency will increase. Okay, so in this way we can say monetary policy also help. It is one of the important factor that is for the long term deciding the exchange rate. Okay, next is what? Interest rate. So how interest rate affects? Simply see, high domestic interest rate, for example say bonds, tend to attract overseas capital, and thus the currency appreciates for the short term basis. Okay, now for the long term, however, higher interest rate slow down the economy. Okay, and weakening the home currency. So you understand here what is a high interest rate. Suppose in India we are having bonds and we are asking investment in the bonds. Okay, and we are offering say 15% rate of interest in the bonds. So whatever the people sitting in the USA NRI, they will say, oh, we are getting 15% return in India, so they will invest the dollar to, they will convert dollar to Indian rupees and they will invest in Indian bonds. Okay, so we are getting the foreign money for the purpose of investment due to the high interest rate on the different bonds or the different instruments. Okay, so whatever the higher rate we are providing, we will get more foreign currency. We get more foreign currency, so our value of Indian rupee will increase, right? But this is what this should be for the short term. This is not good for the long term. If you keep this for long term, what will happen? So we have to pay more money, more rate of interest to other people outside the India, so that will weaken the home currency for long term. Okay, so remember, whatever the high interest rate now, that are good only for the short term. Okay, if you take it for the long term now, you have to pay higher interest for long term, so that maybe weaken the home currency. That means it will having retrospective effect. Okay, so you remember here very simple thing, interest rate affect. Okay, these are high interest rates are good, but only for the short term. If you give high interest rate for the long term, it will have adverse effect on the home currency. Okay, now next is the political issue. Obviously the political stability is likely to lead to the economic stability, obviously, right? Hence the stronger the home currency, while political instability would have the opposite effect. Simply see example of the Pakistan. So in Pakistan there is no political stability. Anytime the military can take over the control over the government. Okay, no political stability. So due to this, the Pakistan rupee is how much depreciated against the dollar. There is a high inflation. So political issue is very very important. You can compare with the India. We are having the strong political stability, strong government with majority. So obviously whatever the investors sitting outside the India, they will think there is good, there can be a stable economic policy, firm decision by the government due to the political stability. So they will invest in the India. They can think about the Pakistan, no political stability, no control, no good environment. How they can invest? Okay, so political issue is also important. Okay, so these are the, so what we are learning. You again come to back. We are looking how the exchange rate is determined. So there are different factors. Fundamental factors are there, apart from that some technical factors are there, and some speculations are there. Okay, so fundamental we have discussed the balance of payment, economic growth, fiscal policy, monetary policy, and the interest rate. Okay, so always remember, fiscal policy is given by the Ministry of Finance and the monetary policy is given by the RBI. Okay, now what we have to discuss is the second, that is the technical reasons. So what do you mean by technical reasons? So see, fundamental are for long term basis, long term reasons, and technical are for short term. Okay, so how the short term, for the short term, value of rupee against dollar will change for the short term basis? See, simply government control can lead to unrealistic value of the currency, resulting in the violent movement in the exchange rate. See, freedom or the restriction on the capital movement can affect the exchange rate to a larger extent. This is the phenomenon in which seen in the Indonesia, Thailand, Philippines and the South Korea during the Southeast Asian currency crisis 1997. So what do you mean by the technical reason? Understand here. See, these are what? These are the short-term reasons. These are the short-term factor. For example, suppose I have taken the article here the India. Okay, in India, price of Indian rupee is suppose 80 for $1. Okay, now Indian government suddenly announced that we are not allowing to increase the price of Indian rupee further. We are very much aware, we are very much concerned about the currency, so we decided to lock the Indian rupee to 80 for $1. We will not allow the fluctuations. Okay, by passing some resolutions or by taking some speculation, by taking some decisions. So whether it will work for longer time? No, because this will affect the currency for shorter duration. Okay, so what I have to say, basically government can't control the currency, but only it can have effect for short term only. Okay, so government can do some actions which affect the change in the currency, one currency to other currency exchange rate for short term duration. Now see here the crisis, one is very important, Southeast Asian currency crisis. So what is that crisis? That Southeast Asian currency crisis mainly happened in Thailand. Okay, it began as a currency crisis when Bangkok, that is Thailand, unpegged the Thai baht from US dollar. What do you mean by that pegging of currency? And I also see, whatever the $1 is equal to 80 rupees, that means we have pegged Indian rupee with the dollar. That means in the globally, if we have to talk globally, how much we should pay, we say we are giving amount in the representing in the form of a dollar. Got it? So that is what, that is pegging we have done. So what happened in 1997, the Thailand government, the Bangkok government, Thailand, they have they previously they were expanding the Thailand currency baht with respect to the dollar, but they suddenly taken over that pegging and they said we will only peg the currency baht, we will peg our currency, we will express our currency only in the form of gold. Okay, for example, 100 baht I will give for 1 gram of gold. Like that they have started dealing globally, and that's why there is a huge crisis in the Thailand. Okay, so you understand the pegging. Pegging means basically expressing your currency with some other currency. Okay, if you are expressing with the dollar, then you are saying pegged with the dollar, but you are expressing that in the form of gold, that means you are not expressing in the form of dollar, that is unpegged. Okay, so see, expression is also important. You are expressing your currency with the dollar, that means globally accepted currency na dollar, that's why it is good. You suppose India started expressing the rupee with they say gold. For example, I will say for 5,000 rupee is nothing but the 1 gram of gold. If I started dealing, India started dealing like that in the global market, that will be very complicated, right? So we may have some setback in the global market. Okay, so what happened in the same way in 1997, Thailand has decided not express their currency from the dollar to baht. They have started expressing the currency in the form of gold. Okay, gold to baht, like that. Okay, that's why what happened, setting up series of currency devaluation has been done, and a massive flight of the capital. So whatever the investment there now, there the people in the Thailand, the investors in the Thailand, they have taken their investment away from the Thailand. Due to what? Due to such a decision by the government. Okay, so these are some short-term decisions, short-term effects. Okay, so we are discussing the technical reasons, and technical means what? Basically these are the short term which affect short term they are affecting the currency. Okay, short term they are affecting the exchange rate between the currency. Now huge surplus generated in the petroleum exporting country like OPEC country, these are the petroleum exporting group of a country, due to the sudden spurt in the petroleum prices, which could not utilize in these country and therefore had invested overseas. So obviously, see, petroleum country like say Saudi Arabia, they are receiving lot of money Why? Because they are having lot of petrol, so they are receiving lot of foreign currency. So obviously uh, they had to invest overseas, so they are having lot of money and they have to invest that into the abroad country, because they cannot utilize such a huge foreign currency. Now this created huge movement in the capital overseas and the resultant appreciation of the currency for the country. So obviously whatever the currency they are having, suppose dirham and dollar, they are receiving lot of dollar due to the export of the oils. So obviously they are receiving lot of foreign currency, so price of dirham will go up. Okay, so this can happen for the short time. So these are the technical reasons. Okay, capital normally tend to move from higher yielding to the lower yielding to higher yielding currency. Obviously, so suppose you are having a rate of interest is suppose 3%, and you are having in India also 3%. But in the USA you are getting it on dollar. In India you are getting on rupee. So where you will go? You will go to the USA, because more the value of a stronger currency. So obviously lower yielding to the higher yielding currency we will invest. Simple thing. And result in the movement in the exchange rates, and that will result into what? Obviously the rate of Indian to dollar will change. See, very simple. Lower yielding to higher yielding currency means what? See, whatever the rate we are getting India, whatever the rate the USA is offering, that may be different, right? If it is 3% same, but the value of dollar is more, so people from India will invest in the dollar in the USA. That's why our capital from India can flow to the USA. Okay, and that's why due to the movement of the capital, again the rate of exchange India dollar to rupee will fluctuate, and these are the short term technical reasons for what? For the exchange rates. Okay, so these are the technical reasons. Now next is what? Speculation. Speculation is very simple. Speculative forces can have a major effect on the exchange rate, and expectations of the depreciation of a home currency or devaluation of a home currency. The speculator will buy the base currency. Say, I will buy at rupees 80, $1 for the 80 rupee, and I will sell it at 80.2 rupees tomorrow. So I will gain 0.2 rupees per dollar. This is what? This is the nothing but the speculation, and that's why this is the rupee gets depreciated against the dollar. Okay, very simple. See, what do you mean by speculation? You will understand here further. See, in the recent, you have gone through one recent, see, Hindenburg report. Due to the Hindenburg report, the price of Adani share went down. Okay, so while publishing the report, Hindenburg said that we have taken the short position. You read that they have stated we have taken short position on what? Adani shares. What do you mean by that? Short position. Short means sell now. Short means sell now and buy later. So due to that, price of the Adani share decreases. Means suppose price is 1000. Now it is decreased to 500 after the announcement by the Hindenburg report. So they have taken short position. So whatever the shares they have, okay, it is allowed. Short position is allowed in the globally, but in India it is very much restricted. So they have sold the shares at say 1000 rupees per price. Price is now decreased to 500, so they will buy it when it is decreased. Okay, so short means what? Short position means what? Sell now and buy later. It is also called as the oversold. It is always the oversold position. So to make money, I will sell the shares. Okay, so Hindenburg has taken a short position. They have sold all the shares of the Adani, and they will purchase it when the price becomes less. Okay, and due to the Hindenburg report, obviously price has went down. This is what the short position. Now what is long position? Long position means I will buy now. I will buy now and I will sell later. So I will buy at a 50 rupees and I will sell at a say 1000 rupees. So this is what long position. Long means what? Overbought. Long means overbought. I think that the price of the Adani group, price of say Reliance today is 50, it will increase to 1000. So I will taking the long position. I will buy it by expectations that the price will increase. Okay, so this is the long means overbought. Long means overbought and short means oversold. Okay, very simple. That two things you have to remember. Remember the best example for short position is what? It is the Hindenburg report on what? on the Adani Group. Okay, they have taken the short position. Okay, so what is speculation? Speculation means you do either long position, you do either short position. You purchase at 80, you sold at 80.2, you have earned 0.2 rupees per dollar. This is what, this is the speculation. Okay, so this is all about the speculation. So we learned there are how the Indian rupees changes with the dollar. We learned there are some fundamental factors, there are some technical factors also, and there are some speculation. So due to these three factors, the rupee to dollar rate changes. Okay, apart from that, you have to do one thing. You have to subscribe us on the YouTube Banker Zone. You can also download the application of the Banker Zone, which is available to download from the Play Store. Link is given in the description. You can join our group on the Telegram application for the discussion purpose. The name of the group is CAIIB Banker Zone. For that, you can directly search @CAIIB BZ. Also, you can join our official channel on the Telegram for the purpose of notes. For that, you can directly search @Bankers Zone JAIB CAIB. Okay, or you can directly search Banker Zone Official. Thank you, friends. We'll continue our discussion in the next video.